Bloomberg Audio Studios. Podcasts, radio, news.
Now, a darkening global economic backdrop has opened the door to quicker rate cuts from the Bank of England. That's as officials eye the impact of Trump's tariffs, a cooling labor market, and tumbling energy prices. Now, markets are fully pricing 3/4 points reduction this year and a 50% chance of a fourth with a cut next month, all but certain. Well, joining us now for an exclusive interview is Megan Greene, member of the Monetary Policy Committee at the Bank of England, and welcome also to our radio listeners. Megan, as always, thank you so much for giving us a little bit of your very busy schedules. Now, markets are now gaining conviction that the BOE will, probably deliver another rate cut next month and more than 3 rate cuts by the end of the year. How comfortable are you with that pricing?
Look, market pricing has moved around a whole lot over the past couple of weeks, and it's also worth pointing out that not all of that is focused on what's going on in the UK. So traditionally, about a third of the moves in the gilt curve have been driven by things happening outside the UK. These days, it's about half that's been driven by things happening outside the UK. So part of those moves, I think, reflect what's going on globally. And, we're just about to go into an interest rate round, so we'll have to see. But I would highlight that those market moves don't all reflect fundamentals in the UK.
Because what, of uncertainties? If you look at, there seems to be a lot of disinflationary kind of impact from falling energy prices, weaker dollar, tightening financial conditions, global demand. Does that point to a cut in May?
So look, there are factors that are both inflationary and disinflationary. I'm particularly concerned. We've had weakness in output for about 9 months now, and we're trying to figure out what the big driver of that is, whether it's demand or supply driven. I think there are reasons to think it's both, actually, but I'm more concerned about the supply side, and that actually on balance would be inflationary. So that's part of it. When it comes to tariffs and the developments over the past couple of weeks, there again are both inflationary and disinflationary impulses. So when it comes to tariffs in particular, for the UK, we're a small open economy, right? The US is our biggest single country trade partner, but the EU, of course, is our biggest trade partner overall. So if you have export substitution, then that would tend to push down on growth and inflation. If you have trade diversion from other countries that are trying to find a new home for their markets, that also pushes down on inflation. But we saw during the pandemic that if you have a repatterning of supply chains, that can push up on inflation. And also if we have trade fragmentation writ large, then that tends to reduce knowledge spillovers, that reduces potential growth, that tends to be inflationary. So something you've mentioned was exchange rates. Yep. And those have not gone as the economic theory would suggest. Normally if the US announces or imposes unilateral tariffs on other countries, the theory suggests the dollar should appreciate. The opposite has actually happened. And so that in and of itself could be disinflationary for the UK, but of course, as I mentioned, the EU is the UK's biggest trade partner, and the euro has appreciated. So net, if you look at the kind of sterling exchange rate index, the pound's up a little bit. There's a ton of uncertainty around this, but there are both inflationary and disinflationary forces.
But are you concerned about the slight recent strength in pound? Does that change actually, tightening financial conditions?
So it does. I mean, the currencies have been moving a lot recently as well. We've also seen off the back of previous kind of structural shift after the global financial crisis, after COVID, the dollar didn't always behave immediately as the theory would suggest. It weakened and then subsequently rebounded. So I think it's a bit too early to say kind of where the dust is going to settle on currencies. But I will say if the dollar continues to depreciate, on balance, that would be disinflationary for the UK. And if the opposite happens, less so.
So are you worried that, and you said in the past actually that there's a danger that it could, muddy the water on inflation, the moves in pounds. So are you worried that there could be a reverse and then it becomes an upward pressure on inflation quite quickly?
It could be. That's right. Currency forecasters have the hardest job, second only to energy forecasters. And like I said, it's been really volatile. We're not quite sure where the dust will settle. If the pound were to strengthen more, actually then we'll be importing disinflationary forces. If the pound were to depreciate, then the opposite would happen. So it just underscores the amount of uncertainty that we're looking at, given that we are basing our policy now on where we expect the economy to be in a year and a half, 2 years time, it's pretty difficult.
And how do you see domestic policy actually impacting behavior? For example, the NICS policy in terms of companies, but also consumers.
Yeah, so the combination of the NICS and the increase in the national living wage is something we've been looking at a lot. We've asked companies through our agency network how they plan on adjusting in response to that. And we've also looked at other surveys that have been done. There are a number of different margins of adjustment. So you could, decrease employment, you could decrease hours, you could offer lower wage increases, you could have it eat into profits, you could boost productivity. When we ask firms how they plan on responding and lay those out, they basically say yes, we're going to do those. And so it's a bit too early. It just kicked in April, right? It's a bit too early to say exactly what the margins of adjustment are. So far, it seems like eating into profits will be the most immediate one, but further down the line, it could end up feeding through into kind of labor quantities, and that's a concern of ours, certainly. So we have incorporated the NICS and the national living wage into our inflation forecast. It pushes up on inflation a little bit by about 0.2 percentage points, so that's not massive, but it is something. But the big risk, I think, is that there could be a shakeout in the labor market. We could see unemployment tick up. There are no signs of that yet, actually, even though the NICS and the national living wage have come to be, so it might be a bit too soon. We see in the kind of forward-looking PMI employment indices, they were really falling before. They weren't performing well, but actually in the most recent one, they've ticked up, which suggests a lot of that was around kind of sentiment around the NICS rather than actual expected behavior.
But has the labor force dynamic changed, actually, for the worse since 2020?
Since 2020.
COVID.
Yeah, I mean, what we've seen is that the labor market has held up surprisingly well in the UK as it has across developed economies, right? So we have unemployment of around 4.4%. That's pretty low. I should provide a big health warning with our labor market data because the labor force survey hasn't been getting as many responses as it did pre-COVID. And that's been the case everywhere, but especially so in the UK. So it's hard to get a real read on the labor market. That said, we look at a bunch of other indicators and series. We have our own kind of indicator-based models, and underlying employment is growing pretty slowly. Unemployment, is ticking up very slowly. We've seen the labor market weakening since COVID, slowly, again, not as quickly as one might have expected, and wage growth remains pretty high. Now, that's wage growth according to the labor force survey again, and it's pretty volatile and actually ticked up at the end of last year. It's since started to come back down. But if we look at other metrics of wage growth, they're also pretty high. And that's important because that's a huge input into services inflation, which tends to be more domestically driven. And so that's something that we're looking at a lot. Services inflation in the UK is around 5%. It's much higher than other developed economies. And that's a sign that maybe there is some inflation persistence in the UK economy.
I was going to ask you what part of the UK inflation spectrum are you most worried about? Is it services or private sector wages?
So I would say I'm more worried about services inflation. It actually has surprised on the downside more recently, and I should highlight that the disinflationary process is underway and continues to be underway as we see it in the data. I'm worried about services inflation, as I mentioned, because it is an indicator of domestically driven inflation, which we can actually do something about. It's the biggest contributor to inflation in the UK. The biggest part of it is actually pay growth, which is why I'm also focused on wages. But one factor that feeds into wage growth, of course, is inflation expectations. And we've seen household inflation expectations rise. And that goes for both short-term measures and medium-term measures. The latter is a bit more worrisome, actually. You don't usually see those rise. So I think they remain well anchored. We've looked at kind of the relationship between inflation expectations and the economy pre-COVID and come up with kind of bands of reasonable inflation expectations now. And where we are is within those bands, but towards the top of it. So it is something I'm looking at as another sign of inflation persistence.
Megan, everything seems to, it's changing so quickly, and the markets are changing so quickly. Is there anything that that you can confidently say will not change?
that won't change, that we'll have a lot of uncertainty for a while is one thing. I mean, there is a lot of volatility. The markets haven't actually really responded as you would expect in the face of a risk-off environment and that amount of volatility. And so that does inject quite a lot of uncertainty. And there's, policy uncertainty coming out of the U.S. as well.
I mean, I was looking at the 30-year borrowing cost for the UK around 5.35%. I mean, it's the highest they've been this century. Is that a message to policymakers from bond vigilantes, or how do you see this?
So it could be, but it could also just be a reflection on what's happening in the U.S. in particular, and a read-over. That's what we've seen since COVID, is that there's just significant read-over automatically, even though the structure of the U.S. and the UK economies are quite different. Because the UK is a small, open economy, it does get dragged around by developments happening elsewhere.
Yeah, how much, I mean, we're trying to theorize about what the Fed does and when they can start cutting. If labor goes down in like the third quarter, is that when they start cutting aggressively? But what's your path for interest rate cuts in the next, 6 to 8 months for the Bank of England? For
the Bank of England. So I have been on the more cautious side of our rate cutting cycle because of all these indicators that there could be inflation persistence. There's also uncertainty. I do think there are risks on both sides. So I'm also careful in our lingo. I think that the tariffs actually represent more of a disinflationary risk than an inflationary risk, though. And so we'll have to see how that develops going forward.
Is there anything that actually, first of all, is it so difficult to know where the current neutral rate is? Yes. Do you have an idea of where it is? Because that'd be good to guide the markets towards that.
Yeah, as you know, we use a lot of different methodologies to try to estimate the real neutral rate. We use financial markets indicators, we use surveys, we ask investors, we use macro models, and they all have massive bands of uncertainty. So I won't give you a point forecast. In February, we put out kind of our analysis on this and showed that depending on which methodology you use, the long-run neutral rate has probably gone up by between 25 basis points and 150 basis points. So that's a pretty wide band. But what we can conclude is it's probably gone up, and this is something I've believed for a while. So I think it's higher than where it was. When we ask investors, they say somewhere between 3.25 and 3.5%. I don't think that's totally unreasonable.
Megan, is there any case that the UK has a competitive advantage with the tariffs? Because given they're at a baseline 10%, which offers, I guess, more certainty for businesses than in the EU where they're still negotiating.
Yeah, so again, we'll have to know when the dust settles, but the EU was given a lower tariff rate than many other countries, and so that does end up being a bit of a competitive advantage, particularly with respect to the EU. So we'll see what happens with the EU tariffs. But if the UK does end up with lower tariffs than the EU, then you might have some kind of substitution. So actually, normally trade diversion, you think of it as disinflationary for the UK, because you think of, for example, products coming from Asia looking for a market, them offering lower prices to find access to the market. But actually, you could get trade diversion from the EU because the UK has lower tariffs. It all depends on how much substitution there really is.
When you look at the complex over the next couple of months, is there a point where if tariffs come down with, say, China or India, does that give you hope for a more settled economic backdrop worldwide, or is it still going to be messy?
So I think there's going to be a lot of volatility in terms of policymaking regardless. I don't expect us to know exactly what the global trade landscape or financial landscape will look like anytime too soon.
I know there's, we led the show actually talking about central bank independence because of what Donald Trump was saying about Jay Powell. I mean, what's, as a central banker sitting on the MPC, how does the BOE react to this?
So, credibility is the currency of central banks, and I think independence is quite an important piece of that, that when we say we will hit our target, and the target for the Bank of England is provided by Treasury, but we will hit our target. I think we can do so credibly because we're free to make the decisions that we believe will most effectively achieve that, and so I think central bank independence is absolutely crucial.
Megan, thank you so much for joining us today. That was, of course, Megan Greene, member of the Bank of England's Monetary Policy Committee, joining us for an exclusive conversation.